guest is Mike Belshe, co-founder and CEO of BitGo, a full-service financial infrastructure and custody firm with over $100 billion in digital assets on its platform. BitGo's infrastructure also handles roughly 1/5 of all Bitcoin transaction value moved on-chain. Before crypto, Mike was a software engineer at Netscape and Google, where he helped pioneer early work on Google Chrome and co-created HTTP2, one of the core technologies powering the fast modern web that we use today. Mike, welcome to the show.
Thanks for having me, Eleanor.
You're now the CEO of a publicly traded crypto company, so I'm looking forward to your answer here. But what does crypto in America mean to you?
Well, to me, it means freedom. Look, I know most people don't think about what is good money, but it's why I got into the space to begin with. When you have good money, actually, you have more freedom. And I do remember really pretty consciously, I think about, 10 years ago, feeling like, the politics, in America that, everybody's got an opinion on, self-included, affect me less than they used to, because I feel like there's a sound money that is behind me, and I hope that everybody has that feeling someday. It's liberating. It's fantastic. So look, I think we still have a lot more work to be done. I know some people are getting maybe skeptical that crypto Bitcoin will fulfill its promise in terms of providing sound money, but I have no doubt that it will. I think all signs that are in the economy today still point to that, yes, we are on the right track with Bitcoin.
Mm-hmm. We've heard the freedom reply a number of times from guests, so definitely aligned with that. But how's the meaning? Yeah, crypto in America. There we go. How has the meaning changed for you when BitGo became a publicly traded company? Did it kind of put more pressure on it or feel more accessible? Maybe this notion of freedom? I don't know. There's two sides to this, right?
I guess I haven't really thought about being a public company or a private company and affecting freedom. The reason that we are a public company is to be transparent. People can see our financials. They can see everything about the business, all the risks. And for all of the faults of the SEC process, it does give the benefit that people can measure us in a way that's familiar. And this is super important for the biggest institutions in America. Of course, they have a difficult time ascertaining what is the risk of working with certain private companies. And sometimes they've been burned by that. So, that's why we did it. In terms of affecting like freedom or the mission, I think more the entire world is going through some learning exercises of what does it take to have a global type of money? Because we've never had it before, right? Every type of money that we've used, I guess gold, maybe you could say it is one, but it's heavy, hard to transport. Even that we end up putting in vaults and kind of leaving it there and using proxies for it instead of the direct gold. But the global financial system has just never been figured out before. And instead what happened is everybody had to put up walls around their nations to protect how money movement flows and how the laws of each land is protected. And everybody picks different laws, of course. And all of a sudden now we have value transfer. They can go across borders instantly. And regulators across the planet have to figure out what does that mean for them? How are they going to live in a much more globally connected financial world?
There's something, Mike, I think pretty uniquely American, though, about taking a company public on the New York Stock Exchange itself. And I think it's actually in the background of your shot today, if I'm correct, right?
Yeah, I'm in BitGo's New York office, and fortunately, we look down on the New York Stock Exchange.
Yeah. And just to kind of pull on the IPO thread a little more, you took BitGo public in January, and at that time, the market was trying to recover from some of that late 2025 pullback we saw. Now we're seeing the next wave of crypto firms delay plans until those conditions improve. I think Grayscale came out fairly recently and said that they were further delaying. We've seen Kraken also come out with similar sentiment. Do you think that there's ever really a perfect time to IPO in crypto, coming from someone who's done it?
Look, the bankers know how to make money, and they will tell you the one variable that helps them make the most money is a bull market. So both for the issuer that's listing stock and also for themselves, they know that they make more money when they do it when the market is positive. So they strongly encourage you to do that. In BitGo's case, actually, if you remember, we were all set to go, I think, end of October last year. And then remember, we had a little government shutdown. And so like everybody closed. So, we got kicked out of October, and then November is Thanksgiving, and then December is Christmas. So we said, look, we want to get this thing done. And we went with January. The bankers are probably right. Like, if your goal is to kind of optimize for how the fundraise is going to go right out of the gate, probably waiting is a good idea. Everybody's got to make their own choice. For us, look, we really felt there's a lot of value. If you're going to be a digital asset infrastructure provider, OCC National Bank, people need to know like what's behind this thing, and we wanted to be public so that we could have that public scrutiny. Then the market is what the market is. Sometimes it's going to be down, sometimes it's going to be up. I think the new thing you learn is like, look, I am fully in on BitGo stock more than anybody. I'm not selling any. I feel the pain. I feel empathy for investors when stocks are not performing as they would like them to be. So I don't want to be glib about it in any way. So you have to watch that. But then also, our business doesn't run on nice, neat quarterly intervals, right? What we're doing here is long term, and it takes years. It's taken us a dozen to get to where we're at today, and it's going to take a dozen more. So you have to be thinking long term. The markets don't always think long term. That creates work to be done in terms of getting everybody kind of to the same stage of understanding where the business is and what the plan is. And hopefully there's investors that are excited about that mission and willing to be on that for the long haul with us. And that's a new job. We didn't have it quite as much before as a private company.
Mike, I want to get your thoughts on something before we move on that notion of sort of long-term holding and cycles not necessarily matching up. I'm sure you guys work with some of the digital asset treasury companies on the custody side that were such a sort of hot topic last summer. Where do you think that is going, just in this idea that public markets are not always responding in the same way that you would like them to, and crypto is kind of new at this game?
Well, listing stocks, launching anything, any token, any stock equity that you're going to put out into a market, it's difficult. Like we've seen this over on the ICO front a few years back. Ethereum pioneered those, and it's difficult to get like a fair launch with a broad distribution of users that have a vision towards something that isn't just like sell it as soon as you can to make a profit. So anytime you're taking something new into a market that hasn't been there, it's always challenging. And we've seen that on the ICO side. Of course, the IPO process is really the same thing. It's just in a regulated market instead of in the decentralized market. As for the DATs, look, it's a new business model in terms of how to create a financial type of product in a public structure. We've got ETFs competing with the DATs. DATs can do more leverage, of course. DATs can sometimes have brands like what you bring with Michael Saylor and Strategy, or like Tom Lee and Bitminer. So a lot of those guys are struggling to prove to their investors that they're going to work out. And I guess people are experimenting with this. I think the great thing is it's innovation. This hasn't happened before. I mean, really, I think kudos to Michael Saylor the most. He really thought of ways to use the public equity markets to build financial products that nobody had ever done before. And I think that's always commendable. And then, of course, there's some copycats. Some aren't going to have quite as good of an outcome. And we'll see. Obviously, there's a lot of them kind of in the water now. I think most people are expecting there'll be some consolidation among those, just like there always is with every type of industry when you have a sudden increase in the number of participants, and some are working and some are not.
Yeah. Maybe keeping on the topic of markets, Mike, you've been in the space for a number of cycles at this point. So how does the current environment compare to maybe previous ones? And what do you think is kind of behind the current price action with Bitcoin? It's kind of like, I got a notification, I think yesterday, it's like 30-day lows or something. We're recording this at the end of May. So, I mean, still bearish, or how do you think about that right now?
Well, I'm forever bullish, I think, probably. As long as we've got innovation happening and new things being done that haven't been done before, I think we should be excited. And, the place where everybody should be looking right now, I mean, tokenized equity is just everywhere. And, you don't have to ask like the third tier guys like me. You can ask like the Larry Finks, you can ask Morgan Stanley, you can ask Citi, you can ask all of the majors. And they are all participating. DTCC is tokenizing. I mean, it is everywhere. So I think this is incredibly exciting. And it opens up all kinds of new things that we're going to be able to do that we haven't been able to do before. On the banking side, we're reinventing banking. I mean, I think the traditional bankers are still protesting a little bit, but we already have a new type of bank that requires way less regulation, is safer, gives you better interest, provides better payments, it does everything. It's called stablecoins. You do that through a regulated structure. It's absolutely better than a depository bank ever was. And it's thanks to new technology. So I think these are incredibly exciting things. Now, as for the price, I think to some degree, people are wondering, whether we're going to fulfill our promise, right? We said we're going to reduce the number of middlemen. We're going to cut the fees. We're going to bank the unbanked. We're going to democratize access. Some things we've made some progress on, but I think we as an industry have not made enough. BitGo's got an internal push. We think retail deserves all the privileges that institutions get. We talk a lot about the K-shaped economy where like the rich get richer, et cetera. Like, why is it that here in the crypto land, we have a world where retail is getting charged 100, 150 basis points, whereas institutions, they're not paying those prices. So by the way, you come to BitGo, try it out. It's open to everybody. You will get institutional treatment on fees, also with the model, also with fiduciary protections. So we think all of these things that institutions demand should be available for retail. If we fulfill on that promise, I think that you will see a massive, reinterest in digital assets and Bitcoin. I think we're just having to walk through some gyrations. One last thing I think is happening. AI is so sexy and so exciting that people are getting distracted by the latest sexy thing that's out there, and it's pretty sexy. You got to say. I mean, it's incredible.
It's not bad.
AI is changing every aspect of our lives, and people are all looking at that. So, look, the good news is there's a lot of building to be done. People say this all the time, but it really is true. You've got the up cycles and the down cycles in crypto. We've seen them over and over again. The folks that are really that are really interested, they keep building through these phases. The folks that aren't really in, what happens is they get really excited when everything's going up, and then it starts going down, and then like the naysayers come in and influence them, and like, you're right, and they go back to doing something else. And we've seen this with false starts in our industry over and over again. I remember Credit Suisse, which of course it doesn't exist anymore, but they had a big crypto initiative. I want to say like 2017, 2018. I remember talking with that team. They're so excited. They're like, we're going to be the big bank that's going to take this innovation, like the management's supportive of it. All it takes is one bear market, and that support weakens. And so then they end up disbanding. They all quit and they go somewhere else, and then it emerges at another company. And we've seen it in pockets. Goldman was very excited at one point a few years back, had to back off. Anyway, overall, I think we should be super excited because we have regulatory tailwinds, which are really, really helpful. It's allowed all of those traditional financial companies that previously they didn't have the right air cover. Call them whatever you want for whatever faults they have. I mean, they legitimately were really kind of stuck without having that regulatory air cover. And now we have it going into a less hot market. I think we get to separate out the builders from the people that are just chasing the next hot thing, which I think is actually kind of good.
Mike, I've heard you say that you built BitGo with the ethos of Bitcoin in mind. So I'm thinking about when you used to work for Google and for Netscape, and you've obviously always been a software engineer at heart, but when did you go down the Bitcoin rabbit hole?
I'll answer your question in just a second since you went down the HTTP path. So I did a lot of work on HTTP. Started, I guess, around 2010, I think. And if you take a look at encrypted traffic that we had on the web from when SSL, which was the encryption layer that we created with HTTPS back in 1995, 95 till 2009, I think about 30% of web traffic was encrypted. The rest of it was not. And building a new protocol, we built HTTP2 and it requires SSL. And from the time HTTP2 was launched till today, it's now like 99% encrypted, which I think is incredibly positive for everybody. And of course, there's always more to be done in security. It's not like the be all end all, but it was a huge step. And that took a lot of push. And I did a talk at the IETF, which is if you're not familiar, the Internet Engineering Task Force. It's the group that's been around. It's a kind of industry ad hoc group, but it's been around since like 1970 with internet protocols. I did a presentation there. I said, it's a matter of life and death. We need to encrypt. And it's interesting. You think back about like, why did we create the encrypted web back in 1995? And that was done by a bunch of smart guys at Netscape, not me. I don't deserve credit. But they wanted to make sure that e-commerce could come to the web. And the only way to do that was to encrypt your credit card. So it was all about e-commerce. But if you look at the history of what happened in terms of points where there were hacks on the HTTPS, the SSL layer itself, it was nation states. It was Iran. It was China. And it was people that wanted to kill their dissidents. So it's not quite the same thing as freedom. But in terms of things that I'm proud of in my career, definitely like helping get everything encrypted, I think is probably maybe the biggest accomplishment. So I'm happy with that. Now back to your question you asked. I started to hear about it, I don't know, in 2012, I think. Maybe I heard about it before then, but I honestly always dismissed it as like probably a scam or would never work. Probably a lot of people went through that phase where you hear about it a few times, like, what, Bitcoin? But no, 2012, I really started to look at it more deeply. Initially, I tried to hack it. Of course, I failed. But I learned some things along the way. And it was just fascinating to see this decentralized system that could, basically protect the double spend problem so that you could, not have to trust anybody about your money. And then once that one clicks, then a whole bunch of other things start to click. So I had never been interested in finance. To be honest, I think it's crazy that Wall Street makes so much money. Wall Street doesn't create any value. Right? It's all the hardworking people around America that make the value. They actually build products and they have to sell stuff. And then like these financial guys make all the money. Like they're supposed to make a little piece of your money, not like a big piece of your money. And so, yeah, for me, down the rabbit hole was really kind of filling in a bunch of the gaps of stuff I had never studied about. How did we get to the monetary system that we have? How does it really work? And all the early questions back then were like, well, it's backed by nothing. And, of course I had a loose understanding of, yeah, we had gold standard at one point, but I had never spent time thinking about it because I didn't care about the financial services side. But then once you realize you can put money into the power of your machine and everybody can have that independently, it's so empowering, and then it gets you excited. That's where the rabbit hole starts.
Yeah, Mike, speaking in terms of back in those days, I know BitGo pioneered like the multi-sig in the wake of Mt. Gox. Obviously, there's a lot of early Bitcoiners impacted by that. More than a decade later, where do like custody and security actually stand for you? And how do you think about other sort of methods of security like MPC? What still needs to improve, and how you think we're doing on the custody and security front today?
Yeah, look, we pioneered multi-sig, which is still the gold standard of how you should protect against theft. We do this thing called a 2 out of 3 threshold model. And the reason we do that is it protects against both theft and loss. Not all blockchains support multi-sig natively. So Ethereum, for instance, doesn't support it. So you have to use something else like MPC. In BitGo's case, we didn't want to use the early variants of MPC because they're either 2 out of 2 or 3 out of 3. And you may or may not be familiar with those, but basically those protect against theft in that there's no single point of failure. But they don't protect against loss in that if you lose any piece of it, you have to have a backup. And the backup has the same problem that you had to begin with, which is how do you make sure you don't have a single point of failure with the backup. So the 2 out of 3 model, which we use, I think we're the only company that stays true to using like protection against both theft and loss across every blockchain we support across everything. So we use mostly the DKLS23 variant of the threshold signature for MPC on chains that need it. We recently saw TorChain had an issue on one of the early variants of MPC. They were using a threshold MPC. They were using GG20. It wasn't quite ready. MPC is much more complicated. You can see cryptographers far smarter than I am talking about, look, these are really complicated protocols. And by the way, most people don't realize this, that cryptographic protocols are rarely mathematically proven to be correct. Instead, what happens is they get distributed and shared with other cryptographers. And after 10 years, then people are like, okay, it seems like maybe this one's safe. And literally, like 10 years is what it used to be. Now, we've been moving faster than that in the digital asset space. But that does, of course, mean there's some risk. So I think we will continue to see new cryptographic algorithms. Obviously, the latest driver of this is fears about quantum computing. As you may know, the ECDSA curves, which we use in Bitcoin, may be vulnerable if a quantum computer is built. So this is actually on the minds of a number of people that don't understand the technology. They're thinking like, well, gee, am I going to go put in $50 million into this thing if like a quantum computer is going to kill it in 2 years? And it sounds like Google's going to do it. My own opinion here is like, first off, I think it's unlikely we see a quantum computer that can actually do any of this. But if we want to have the world understand that they can use digital assets, we have to take care of this fear, and it's a real fear. So I've definitely heard this a lot. And this will drive new variants of how do we do signing on various blockchains, and that, of course, will lead to new protocols for how you do security. Look, I think all the experts are in agreement. Of course, you need to eliminate single points of failure. This isn't some great novel thing that BitGo invented. It's a basic principle of how do you secure things, whether they're digital or something else. So I think we'll have new good algorithms that continue to deal with this. From BitGo's perspective, I think we've solved this particular part. We're also big believers in cold storage. A lot of other people take shortcuts, and you can see, unfortunately, there's been a lot of mistakes that have happened, even in the last 24 months, where people didn't take as hardline approach to security, but obviously our clients, they pay us to make sure we take care of all these details. We do 100% cold storage. And then people sometimes are like, well, isn't that going to be slow? Look, we can get you out in less than an hour, 7 days a week, 365 a year, right? And the reason for that is we build buffers, which is our risk. So your money stays in cold storage. We put some money into hot wallets, but we control that risk. If we ever lose that, that's us. Your money stays in cold storage all the time. Obviously, if you want to move $100 million, it's going to be a little bit slower. But even going through the full cold storage process, it's not that long, a few hours.
Mm-hmm. Mike, how much of BitGo's role today is acting as a regulated bridge between traditional finance and crypto, given its kind of increasing relevance on the infrastructure side? And then to the point that you're talking about before on custody, and then also tying in licensing, like there's so many different moving parts, right? But how much does that impact things as more and more traditional institutions enter the space?
I would say 100% of our business is this bridge between crypto and regulated. We do technically still have a self-custody wallet layer. You can use that. It's not really a regulated product because it's self-custody. Some clients use that in concert with our custody products. You get one interface. You can see your self-custody wallets, use custody wallets. It's all there together. You can move them very, very, very easily between each other. But when it comes to business, custody is just kind of a requirement. It comes in as a requirement in a couple of different ways. One is large funds are required by law to use a qualified custodian. Okay, so there's that part. But then even if that weren't required, if you're running a business and you've got a bank account, you've got multiple people from the company on the bank account. You've got policies. The CFO can set who can spend how much. You've got auditors that come in on that. So there's a whole business of banking that's not crypto specific, but any business needs it. So it's not like the regulator is coming in and saying, oh, you have to have this, and otherwise people would just use cash. No, people want this custody. It gives them a level of safety. It allows them to have business continuity. People can come and go from the company, and yet you don't lose your money. This idea that you're going to, give it to the IT guy and he's going to put it on a ledger device and stick it in a drawer. I mean, that obviously doesn't work in business context. So this is where we focus, is making sure that our clients know that they've got a full service of banking. And maybe things that surprise people is like, if you think about crypto, you might be thinking like, oh, it's Bitcoin and it's Ethereum and all that. But of course it's those, but also it's the stable coins, and also it's dollars. So we take dollars for people. We can help you convert to stable coins. Oh, you've got USDT. You want to convert that to USD1. We can do that for you. Oh, you don't want to touch stable coins. You just want to have dollars. You can receive stable coins from your clients. We convert it to dollars. You get a wire. Oh, you want to send out a stable coin? Send us the dollars. We'll send you that. So this is the business, is really helping the traditional world interface into digital. And of course it has to be regulated, and of course it has to be custodial.
Mike, how are you thinking about competition from some of these Wall Street firms who are also building out their own infrastructure platforms? Because you guys have the crypto as a service, and I think software as a service available to some of these firms. But then is BitGo ultimately competing with those firms while also providing services to many of them as well? How do you think about competition here?
Yeah, look, I mean, we welcome it. Some of them are our clients. Sometimes we compete with them on different levels. But in general, like, it's fantastic to have the large brands in the space. It's incredibly validating to everything that we do. And of course, they've got massive distribution channels. So, that brings more people into the industry. For BitGo, like, what's our strength? Well, we're an innovative company, right? So we can move very nimbly and very quickly. And even as others come into the space, there's new things changing all the time. So actually, something I have to revisit, I do recall several years ago, one of my investors said, oh my God, you're in like the fastest changing company in the fastest changing space we've ever seen. I think AI is now faster, probably on both counts at this point, but there will continue to be that. And so the traditional firms, they need help. And there's plenty of examples of this. Like, we do a lot of work with Fidelity. Fidelity has a fantastic custodian of their own, similar to BitGo, OCC chartered, all that. And of course, it's Fidelity's brand. I mean, who wants to store at BitGo if you can store at Fidelity? Fidelity's way bigger, right? But Fidelity's product offering isn't able to move quite as fast as you would expect, right? So I don't even think they would be offended for me to say that. So we're able to work with them in a whole bunch of ways. And I think we'll continue to have a role. On the actual security components, the technology around Bitcoin and blockchains and all that, this is a new muscle. They do not have it formed yet in traditional finance very well. So they need help, and they come to us.
Mike, there are a lot of new muscles being formed on the regulatory side here too, and I think you guys met with the SEC task force in 2025, talking to them about some of the need for implementation around broker-dealer rules, investment advisors, and some of the ways that Wall Street is coming into the space. Where do you think the regulatory side of this has made a lot of progress, and where do you think it's still kind of stuck in that building out these new muscles?
Well, Genius is good for stablecoins. It'll still need further refinement. Of course, retail should be allowed to get interest on their money. The idea that they shouldn't is insane, but okay. So there'll be iterations on that, but it's still really good to have it. The other one that we need to have is something like clarity. Unfortunately, I don't know, every day goes by, it's you got to wonder a little bit more as to whether we're going to get this time around or not. I think one of the problems is that we have gotten into a world where digital assets are a little bit political. And so everybody that's been in the space has been stung and knows what it's like when you have a political stigma against you. And these are just tools. These are financial tools. It should not be disputed. Like, it should be people helping others with financial products. It's simple. It's not political. But unfortunately, it hasn't always been that way. And then I guess some of that's just related to politics. I think the other thing that is coming into play, though, that might be a little bit deeper, you don't hear people talk about it a lot, but it is worthy of note. There's some that are statists, meaning they feel that the full power should always reside with the state. And there's other that want more individual liberties and freedoms. And so these two do collide. I wouldn't say this is a perfect party one way or another. I think actually you've got different political leaders that take a more of a state first route. And those people don't like digital assets because digital assets are absolutely empowering to individual liberties. So this is kind of the political fight behind the superficial one that you see with some of the early reactions. Look, it's going to take a while. Definitely digital assets are global, and regulators have to struggle with what does it mean to have regulation when it's global. They want to have control and certainty over their constituents, and then now all of a sudden that's broken up. So those are some real problems have to be solved. The technology is hard to get your head around. My own personal belief is that one thing that Americans have liked historically is regulators that prevent bad guys from doing bad things. I generally agree with that statement, but it's really not a yes or a no. It's a level of how deep do you want to go in order to get it, meaning how much privacy do you want to sacrifice, meaning how much cost do you want to spend in order to make sure bad guys can't do bad things. And especially that's hard when those bad guys may not be regulated or under the jurisdiction of our laws. So I think Americans are going to have to just get used to the idea that, yeah, you got to be a lot more careful about where you put your money in the future. There are a lot of scammers out there. They may not be in your nation. They may not be, have to do anything with your police. So this is a new set of problems that will cause legislators and regulators to continue to churn for a while. And we probably have 20 more years of global churn on just how the laws are going to shake out.
Yeah. Do you ever worry that pursuing a federal regulatory path through the OCC could actually create vulnerabilities under a less crypto-friendly admin in 2029 or just down the line?
I guess, people raise that. And sometimes you think about it a little bit, but it's not really worth spending too much time on because it's just what if. There's a lot of what ifs.
Of course.
What I do know is that regardless of what happens, we will do right by our clients, and we will continue to roll and go get the regulated licenses that we need to, and we will find paths. So, yes, if something, if we were to go back to the previous administration at the snap of fingers or something, that would be annoying, and we'd have to go deal with it. Until then, no, we don't spend much time on it. Like right now, we just want to build, and you build on the things that are certain in front of you, and that's the rules and regulations you have in front of you now. We don't have clarity yet, so we can't build for that yet, even though we might hope that it comes.
Yeah. On the front of the OCC charter, Mike, you recently wrote an op-ed, well, not an op-ed, it was actually an open letter to Senator Elizabeth Warren defending BitGo's OCC trust charter after she wrote a letter to Comptroller Gould basically criticizing or questioning the legality of giving crypto access to these charters. But it was a long letter. You made some great points.
Like it.
I liked it. I liked it a lot. I quoted it in my Crypto in America newsletter yesterday. So
all right,
I'll
great.
send that over to you. But you defend the fully reserved banking model as opposed to the traditional fractional reserve model. We've heard this argument a lot, especially here on the show. We had Scott Shea on with us last week, who is the former chairman of Signature Bank. He's now building Next Bank, which is a fully backed reserve bank. But you talk about this is a new opportunity to rethink how banks work, but what would need to change for that model to become more mainstream and for people like Elizabeth Warren to really understand this new type of model that the crypto industry is pushing for?
Well, look, reserve banks have been around for forever. I think we haven't had technology really kind of catch up in a way that made it useful. So as individuals that had banking choices, we have opted for depository banks rather than reserve banks. And the reason we did that is because we like our free checking accounts and we like getting maybe a little bit of interest, et cetera. And so as people, we've made that choice, and that's our choice to make. So that's fine and that's free. Reserve banks in the past required collecting fees. Obviously, if you're not able to take the assets and lend them out, then you had to charge people fees instead. So they just weren't as popular. I think actually the bank is fully plumbed. And in my letter, I was actually trying to address a couple things. I hear over and over again, people say things like, oh, a full service bank, as though we're not a full service bank, or an insured bank, as though we're somehow a lesser bank. And really what I wanted to do is start with, let's talk about what are the types of bank variants that exist. And frankly, I think the reserve bank has always been a safer bank. This has nothing to do with crypto. It's a reserve bank. That means it holds the assets that you put there instead of lending them out. And when you look at the heaps and piles of regulation that's been added to bank companies, the Bank Holding Company Act as well, all of that has to do with how do you provide safety and soundness, meaning I'm taking deposits, which need to be fully liquid 24 hours a day, 7 days a week, and then I'm committing them to long-term investments like mortgages. Like, how do you balance that so everybody can have their money? And of course, the answer is technically you can't, but in a large enough pool, you can sort of make it work. All this regulation has to do with making sure that banks don't screw that up, because banks have screwed it up, of course, many, many times in history. And I think we've gotten to a pretty reasonably safe place. I'm not trying to say that it's completely terrible. But to say that BitGo, which just keeps all your assets in 100% reserve, is somehow not doing something that these other guys are, is ridiculous. It's actually the opposite, which is true. So the biggest thing I wanted to do was let's change the nomenclature. And by the way, the US government has participated in creating a brand of trust around banks so that people would trust their banks, because it is helpful if the economy goes around by everybody depositing at the banking system. And they've created a mirage that a bank is safer than it is. I mean, you start to hear this word depository, you're like, what's a depository? BitGo, don't you take deposits? Well, yeah, you can deposit into the bank, but we're not allowed to lend it out. So a depository, you can make the deposit and then they can lend it out. It's called demand deposit, meaning that if you ask for it back, I'm supposed to give it back to you on demand. And our bank doesn't do that. So I proposed in that letter that we kind of use common terms, and we should have fractional reserve banks, which is a depository bank, meaning it keeps part of the reserves, but not all of it, and takes some risk with your money. And then there's reserve banks, and reserve banks just keep all of the assets and don't do that. Interestingly, and I bet Senator Warren doesn't know this, but when you have an account at BitGo, we take a fiduciary duty to protect your funds. When you take a retail deposit account at name any of your banks, they are not a fiduciary for you. And what is a fiduciary? Well, look, a fiduciary is a thing that's going to get debated in court as to whether somebody took fiduciary level of care. But it's serious, right? It means that the management teams of those companies know that their duty is to keep your money safe. You have one job, don't lose the money. And if you fail to do that in good state, like if you just put a private key underneath your keyboard or whatever, that would not be good fiduciary care, and you would get penalized. On the banking side, that's not true. Now, I'm not saying that they are acting against you in all cases. Commercially, they have a very good reason to work for you, but it's not actually mandated by their regulatory structure. So, look, I think the reserve banks are just better, and I think technology now makes it so that you can get everything that you ever wanted out of your bank. You got the payments that run 24/7, almost no cost. You can get a great interest rate that's better than what banks are providing today, and you can get better safety. So, I'm sorry, Senator Warren is actually just wrong about like what's the most risky and not. And one little funny thing I do that people get a kick out of, I say, which one would you rather have, Eleanor? Would you rather have your money in an insured bank or an uninsured bank?
Based on that statement, an insured bank.
Look, an insured bank sounds safer, right? But of course, what we're referring to is Federal Deposit Insurance Corporation, which is required for depositories because they take risks with your money. So BitGo is actually not eligible for FDIC insurance. Even if we wanted it, we're not eligible for it. But we don't need it because we didn't lend out your money. So in Senator Warren's letter to the OCC, she specifically said they're not insured banks, therefore implying that we're not safer. But we're not insured because we don't need the insurance, much like the person that doesn't drive a car doesn't have car insurance. They don't need it. Yeah.
Yeah, Mike, we've discussed that topic on the show a bunch, and I think you nailed it. I want to ask you kind of a more practical question around something that has become a big topic of debate on the banking and custody side, which is this notion of access to Fed master accounts. And then also, we've been discussing like OCC charters and the way like reserve banking will work. We had Caitlin Long on the show. We've had Scott from Next on the show. And this always comes up in terms of access to a Fed master account. What practically, because we've never really dug into this, what practically does a Fed master account give to a bank that may be fully reserved that they wouldn't be able to access otherwise? Like what's a differentiating kind of factor there?
Well, basically, it gives you access to the banking system so that you can move money between other banks, super easy. And then at the end of the day, I don't know, kind of all money is actually going through them. So I don't understand any reason why an OCC chartered National Reserve Bank would somehow be treated differently than an OCC National Depository Bank with regard to Fed master accounts. It just doesn't really make any sense. They're doing the same thing. There's this implication, and I don't know, maybe there's some history that I'm not aware of where there was some mini bank that was not subject to all the same rules. A lot of times you'll hear people talk about they need to be doing AML, KYC, and anti-money laundering. We do that. We've always been doing that. And guess what? It's not just me that's required to do that. You're required to do that. This is part of, the Bank Secrecy Act. Every American is required to take particular cares around not hitting sanctions and things like that. So this implication that like we're a mini bank or a lightweight bank or a narrow bank, I think it's just, I don't know, FUD, intentionally thrown in order to not have competition from a new type of bank.
Yeah, that was my next question to you was, is the concern really now banks are just worried that crypto platforms are coming to eat their lunch?
Look, I don't think they should worry about it the way you just described it. I think, I think they probably don't quite consciously think of it that way. I think they're worried about change. I think if you've got a business model that works and you've got duties to shareholders and, all of your constituents that you want it to work at least as well as it is now, change can be scary. So I think it's mostly just resistance to change, which is probably wrapped in human nature as anything else. But I think there's a big important part. I mentioned the K-shaped economy a little bit. I think people don't really realize what's happening is, again, the big guy is winning and you, the retail guy, is losing. And when you think about what a depository bank does, they've got two types of clients. Number one, they sign up a bunch of people to deposit their money, okay, and that's a job. And you can attract more money by giving a higher interest rate if you want. If they all, in some oligopoly or whatever, decide to all give you a low interest rate, I guess they can all decide to do that. The other set of clients they have to sign up is people that are going to borrow money because this is how they make money. And of course, the bank keeps a spread in the middle. So here's what happens. You get all these depositors, retail people, to put their money into the bank, and you give them a little bit of payment service. It's not even very good. They still have to get their own Venmo and PayPal and Cash App accounts. But you do that for them. And then on the other side, you go and you find people that need to borrow money, that are stable, low risk. Who is that? Well, that's the big rich guys, right? Usually corporations, other things. Anyway, those guys are now doing $100 million borrow out of the bank. So the bank makes a lot of money on these guys. And what should the interest rate be? Well, if the risk-free rate is 4%, I know it's a little less than that, but let's say it's 4%, then, and you're taking some amount of risk, and then the bank's going to keep some amount in the middle. Let's say it's 4%. That should, you should at least give your depositor the risk-free rate. You should give them a little bit more if you're taking a risk, right? But let's talk 4%. We'll give them at least that. And then there's some amount of risk, so you got to charge that off to the borrower. And then you're the bank, you're going to keep a chunk of it. So let's say you said it's going to be 4%. That's another 4% to the borrower, and then you're going to keep 2%. So I guess total 6% got that. All right, so you're going to charge 10% in total out to that borrower. Now that guy calls up, he says, hey, Wells Fargo, look, I love you guys, you're wonderful, but I only want to pay you 9%, and I think this other bank is going to do it. The bank has a couple of choices. He can either reject it, maybe the guy leaves as a client, or he can reduce his own fee, or he can reduce the depositor's fee. And what's happened in America is that we have compressed down what the retail depositor gets to basically zero, because the banker didn't want to give up his fee, so he preserved that while he shrunk down what the institutional guy has to pay. So the institutional guy with the $100 million loan, he still works with the bank. He's getting as low as he can. And now you kind of get banks competing for how low they're willing to go on their own fee, while basically just abusing retail. And this is what happens over and over again in various types of business. You've got the big client, he's $100 million versus, a million people each doing $100. They just don't have enough power individually. So anyway, I think we can fix this. I think the new banking model is going to be absolutely better. Are loans going to cost a little bit more to borrow? Probably so. But that's probably healthy for the market, actually. And the market will adapt, and we will create lending markets, and those lending markets will be open to everybody. There's no reason why we have to have this coupling of retail deposits to institutional lending, et cetera. So anyway, yes, I think banks are fear of change.
Yeah. I want to ask you, kind of looking to the future, Mike, for BitGo, and maybe your personal stance here is the goal for BitGo to remain a standalone infrastructure provider long term, or do you kind of see BitGo and other crypto infra service providers in this realm getting folded into traditional finance over time, and it just becomes like one big conglomerate?
Well, there's a bunch of things there. And, to some degree, I get this question years ago when you're a smaller company. What's your plan? Is it to be independent or be public? Or
Sure.
Look, you just always build the best business. And then I have a duty to shareholders to deliver value. So that could come in many forms. And I wouldn't want to neuter any one path, at this point. Lots of things could happen. I hope you can tell from, kind of this conversation where I'm excited. The ability for us to rethink how banking works, have a lighter weight regulation while it's safer, while people are getting more for their money. I think that's pretty exciting. Tokenized equities coming in, changing the way the capital markets work for the better, creating better access, making it so that the little guy can take a loan against his stock, just like Jeff Bezos can take a loan against his stock. I mean, there's big gaps that we have not filled, and we can do that, but I would like to see that happen. So when you say could we fold into a big traditional firm? I mean, I would never rule it out. Again, my job is to make sure that there's good shareholder value and lots of ways to manifest that. But I'm also very excited, and I think the entire team here at BitGo is very excited about, can we make a better financial system on all of these different fronts? We've mostly been talking about the US side of things, but we're also global, right? So we do this in Germany through our BaFin license. We do it in Singapore through MAS, a bunch of others as well. So there's a lot of work to be done.
You guys also provide the infrastructure and custody for stablecoins. I think you guys have USD1 from World Liberty and SoFi USD. And I saw that SoFi began rolling out their product to some of their customers very recently. As we're recording this, I believe it will be last week. But as we're moving toward a world where every major bank seems to be issuing its own stablecoin, do you see that as sort of the future of the stablecoin market?
At least for now, it probably is. So Genius Act prevents giving interest down to the proper owner of the money. So because of that, the issuer of the stablecoin gets to keep all the money. And that makes everybody want to be an issuer. So if you have a collection of clients, users, some collection of money that's in a pool somewhere, you have a choice today. Either you issue your own stablecoin and you get to reap the rewards and share it however you want to, or you give that to somebody else to do. So right now, yeah, there's an explosion of stablecoins because people don't want to just give that up to somebody else. Interestingly, as is often the case, the legislation kind of gets in the way of the free market. So if it weren't for the legislation, I think what would happen is that stablecoins would be very much like an ETF. You would have like a 15 or 20 basis point management fee, just like an ETF, and the rest of the would just go back, to the users. And the idea that you're going to take a 4% fee to manage a stablecoin, I haven't heard anyone say that sounded like an appropriate number.
So, Mike, generally, when we wrap, we ask folks, what is something outside of crypto that you've been paying attention to lately that you think the audience would find interesting? We often get AI as an answer here, so I'm just gonna fold this in. And if it's something besides this, then would love to talk about that. But you mentioned AI a bit earlier. We've talked a lot about agentic payments, how that can impact wallets and all kinds of things on the show. So just outside of kind of crypto and the topics we've discussed today, what's something that's really interesting going on that you think our audience should be paying attention to?
I was thinking the same thing. AI, of course, is interesting to everybody, but we shouldn't say it because it's too obvious of an answer right now. But look, this one's not that unobvious either. I think it's fascinating that we're going to have data centers in space. And maybe those are, in part for AI or largely for AI. I'm not quite sure, but it does seem like we've definitely turned a corner in terms of our ability to use space in interesting ways. I think Starlink is phenomenal and fascinating. So I guess I don't know, I'm pitching SpaceX here, I guess, accidentally, but I think these are pretty cool things.
Yeah, and I heard Gary Tan talking recently about a YC batch company that's doing nuclear fusion apparently in space. So yeah, I think it's gonna be interesting for sure.
I guess if you're gonna have nuclear reactions of some sort happening.
Yeah, just go start a star up there. That's fine. Yeah.
Mike, thank you so much for coming on today. It was a great conversation.
Yeah,
Thanks for having
Mike.
me. Really appreciate it.
Thanks, Mike.